Welcome, everyone. Good afternoon. Welcome to the New York Alternative Investment Roundtable's latest DEI workshop, Diversity as a Profitable Business Strategy, How to Change the Status Quo. I'm Kunjan Mehta. I am the Vice President of the Roundtable. And with me here, we have three awesome panelists. But before we get to business here, I would like to thank all of our sponsors. They're listed on the screen here. Without their support, these events wouldn't be possible. So thank you very much to all of our sponsors and friends of the Roundtable. From a logistics standpoint, this is a webinar, so you will not be able to speak. However, there's a Q&A section on the bottom. So as the panelists discuss the topic and make their presentations, please feel free to ask your questions and we can answer as appropriate. But with that, Holly Singer, please take this away. Thank you everyone for being here. Enjoy.
Thank you very much, Kunjan. Hello, everybody. Good afternoon. Today, we are lucky to have a very diverse panel of experts here to share with us their thoughts and insights on why diversity and equality is not just important, but how it can actually help your business perform better. First, I'd like to introduce one of our speakers, whose name is Ward Corbett. Ward Corbett is the founder and managing partner of global macro hedge fund management firm Catalyst Partners. Ward also serves as chairman of the board at the New York Urban League, where he presents the annual Champion of Diversity Award. In addition, Ward serves as a member of the UN PRI Working Group for the Hedge Fund Industry's Guide for Responsible Investments. In addition, Ward is a council member of the Brookings Institution, which is the nonpartisan think tank. So thank you in advance, Ward, for being with us today. Next speaker I'm delighted to introduce is Michael Creighton. Michael is a professor and chair of accounting, economics, and finance at Houston Baptist University. Michael specializes in the development of business strategies that generate long-term sustainable value, where he analyzes opportunities and risks with complex factors and highly uncertain outcomes. So Michael, thank you in advance for being with us on today's webinar.
Thank you.
And today's moderator, who I'm delighted to introduce, is Jamie Crump. Jamie has focused her longstanding career in strategic sourcing and supplier diversity across a variety of industries, which include banking, heavy equipment rental, pharmaceuticals, technology, telecommunications, welding, medical supply, and financial services. She is an author of many publications. Most notably, she wrote a book called Backstage Pass, Pulling the Curtain Back on the Business of Supplier Diversity, which is a go-to reference on ensuring success, building and implementing a supplier diversity strategy. Jamie has also written and been quoted in many publications on this topic. So thank you, Jamie, for being with us today. And now, without further ado, I would like to turn things over to Jamie Crump.
Good afternoon, everyone. Thank you so much for attending. We're happy to be here. We have a great discussion today. This is a great topic that I have a lot of passion for, obviously. We're going to be speaking to the different people that we have here today, Ward and Michael. We've also got some goodies for you to take away with you, some reference materials so you can do some additional research if you're so inclined. And really, this is all about diversity as a business strategy. And throughout my career, working with supplier diversity and also working with D&I with my internal sourcing clients like HR, we were very often trying to come up, why are we doing this? Why do we want to do this? And my experience has been that treating it like a business strategy, just as you would any other business strategy within the organization, has always been the best pathway for me in terms of creating success. So to that end, we're going to start with Ward today. I'm going to ask each of these gentlemen to tell us a little bit more about their background, as well as then how they see not only the work that maybe they've been doing around diversity and inclusion and equity, but also what type of differentiators they've seen perhaps over the last 18 to 24 months with the pandemic. So Ward, let's start with you.
You're muted.
Ward, you're on mute.
Ward, unmute.
There we go. Okay, sorry about that. Thank you so much, Jamie. It's a great honor to be among such esteemed panelists today. I really appreciate this. Holly has done such great work in the space. But let me just start by telling you a little about myself. I am the founder and managing partner of Catalyst Partners, a global macro hedge fund. And we trade across asset classes, currencies, commodities, interest rates, and equities, delivering uncorrelated risk-adjusted returns to our investors that outperform over time, using an array of technical analysis, fundamental analysis, and quantitative tools. What we're seeing in the market right now is more of the same. It seems like if you look at just this week, on Monday, we had a pullback in the markets due to potential economic impacts of the Delta variant of COVID-19. There are a few other variants around, the Lambda variant, the Beta variant. So we'll see if these continue to spread. But a good friend of mine likes to use the term BTFD, but I'll just use BTD, which has been proven this week with a return to a buying, which is buy the dip. So buy the dip actually has been working, and it's going to continue to work in the capital markets until the Fed determines that inflation is not transitory. This inflation story is heating up in a big way. We're seeing it in many more places other than the Wall Street Journal, so it will be on everyone's top of mind going forward. So yeah, so part of what I do is very exciting. There's a huge opportunity in running a minority-owned hedge fund. There aren't too many of us. But currently, thanks to Holly, actually, I was able to do a talk on Asset TV a few years ago, where I discussed the asset management industry and the current status. And at the time, there were about 1.3% of the assets controlled and managed by minority or women-owned funds. And that's out of $70 trillion in global assets. Just a few weeks ago, the SEC stated those exact numbers in their push to take on the need for diversity and inclusion in asset management. And so it's a long time coming. It's a slow process, but we are seeing some progress in the space. So I would just like to talk more about that and the need for minority managers or women-owned managers. There is a huge opportunity there for allocators to find outsourced alpha, because it's proven that minority managers are outperforming majority managers, as well as women-owned managers. And I don't know if you saw this, but there was an article in the Institutional Investor magazine last week criticizing women managers, which proved to be false, stating that women that have children in school were not performing as well. Obviously, we've had some great women leaders to dive in on that and dissect that with the proper data to prove that was not true. So yes, there's a huge opportunity here. And so I was able to participate in the United Nations PRI. Oh yes, this is the slide that kind of tells what I was just talking about in the capitalist system. If you don't have access to capital, it's going to be a problem. This is a slide put together by the Ford Foundation and their interest in in increasing diversity in the investment management space. It's plain as day, the numbers are clear, and there's nothing to really kind of disagree with here as far as the need. But the question remains is, how do we get here, and why is diversity and inclusion so important right now? I'd have to go back to, I guess, a year ago today, when Daniela Frazier recorded the killing of George Floyd by a police officer. After that video was seen by the rest of the world, there was unrest and social unrest throughout the country, and people were made aware of what was happening. And so right after that, we had many CEOs, many corporations making promises of policy changes or policy additions to address the diversity and inclusion issues. And so it is now a year later. And so the question is, where are we? How much progress has been made? Policies are great, but outcomes are needed. And it's the outcomes that I think that offer an opportunity for innovation in the D&I data collection as we go forward, as these companies begin to set goals for D&I, diversity, equity, and inclusion. So there are some great resources out there that talk about the need for increased diversity and inclusion in the investment management space. The Knight Foundation is a leading organization in this space, the Ford Foundation as well. So there's a lot of information out there about why large allocators should look at diverse managers a little bit more closely. So yes, I think this is a time. I think it's not just a moment, but it is a movement, and it's time to make more people aware of these issues. And so I really appreciate being here. Jamie, Holly, Michael have a lot to add to this story. So it's my pleasure to kick things off, and so have at it. Thank you, Jamie. You're muted. You're on mute. It's contagious.
I know it is. I was doing so well, and now I've caught it. So thank you, Ward, for that. We really appreciate those insights. And as you can see here, there's some resources and some thought leadership. Each of us have brought some of that to the table today. So you will have opportunity to get that following this, and talk just a couple of minutes on the ones that I included. There has been, as Ward said, there's been a lot of attention paid. My background is strategic sourcing and supplier diversity, and never in history have the two things that I do been as much under the microscope as they have been for the last 24 months. So on the supply chain side, you've got everyone trying to respond to the pandemic. There is a lot of shift happening in supply chains right now, as they've learned that maybe perhaps they weren't in the pecking order for things like PPE that they thought they were from their suppliers. There's a lot of discussion about bringing things back over near shore or onshore versus putting all your eggs in one country basket, even if it's across different companies. And, diversity is kind of an interesting thing. I mean, none of us would think of doing a stock portfolio with one stock in it. Or even one industry. Everybody likes 31 flavors when they go pick out ice cream, but yet we have to make the business case for diversity in business. Over and over again, we have seen the data that proves that the most diverse groups generate the best profits and the best results. So with that in mind, a couple that I'll point out on mine is McKinsey has done reports. There's a 2020 report that's out now, but they've actually been looking at this since about 2017. And so you can actually get a year over year. I'm really looking forward to the 2021 to see what kind of impact all of this between the pandemic and the social unrest has made. But it's a really good look if you want to see why this matters and how it's impacting businesses. I'll also give you a shameless plug for the book that Holly was gracious enough to speak about earlier. Backstage Pass, I really created this when I left the corporate environment in 2017 and moved to consulting. I had difficulty finding resources for my clients that really spoke about the business side of this. So yes, there are all kinds of reasons to do it for community, and there's the social and financial impact, ripple effect. But there's a lot of really good, sound business reasons that companies should be doing this. And that's really what I wanted to fill the gap for my clients. Harvard Business Review has done a number of articles on diversity. If you have access to those, you can go do a search, and there's a number of them. But this one that I put in here in particular talks about the financial performance and how diversity actually drives that. And then finally, the Hackett Group has also been doing some studies on this and some research. And this shows what steps companies are taking. So in a lot of cases, you have companies right now, there are venture capital companies that are coming out now and saying, we're just not going to invest in companies that don't have diversity on their board, that don't have diversity among their leadership team, and who are not looking for diversity through their supply chain. So as my role as a consultant, I used to get calls from companies who would say, we talked about it on the board. We've all agreed we want to do this. We want to start. We've done some research. Now I'm literally getting calls from companies who are saying, I don't want to lose my investment dollars. So yeah, this sounds like a great idea, but what do I do? So, this study from the Hackett kind of gives you a sense of what to do first. So with that in mind, I'd like to move now to Michael. And Michael's going to give us some insights around on metrics and reporting standards. This is so important in the diversity realm, because A, people pay attention to what's being measured, and B, you really need to know how you're doing along the line. There's this tendency to think that you get to A and then, hey, we're done. So Michael, take it away, please, for us.
Yes, thank you very much. As you can see, I do learn from experience. I have stayed away from the mute function, and I've just tried to remain very quiet. So, so far, so good. Yeah, I am a CPA. I've actually been working in this space since the 1980s. We didn't use the word sustainability then, or the phrase corporate social responsibility or diversity. But even back then, you had leading companies like the then independent Ben & Jerry's producing essentially diversity and environmental sustainability reports. And we've fortunately come a long way since then. I get a number of questions a lot. And so I'd like to try to hit them proactively or preemptively. I do understand that some of you might be relatively new to this particular field, and some might be more experienced. If you're relatively new, then I'm going to recommend that you at least skim the material in the first 3 bullet points on the slide. No, there will not be a quiz at the end of the session, but still, that's where I would start. If you say, well, that's good, because I always thought I knew a little bit about this discipline and at least somewhat familiar with the first 3 bullet points, then you are somewhat more advanced, and perhaps you can give the 4th bullet point, that link, that content, a quick skim. But why? Well, there are 3 great challenges. Speaking as an accountant in this field, that are challenging us and making it very difficult to know how to allocate capital. And I mean literally, not theoretically, literally knowing where to put your money and how to shift your money from a policy perspective and a practical perspective. Number 1, what are we measuring? And are the measurements consistent across firms and across industries? If you don't have that consistency, then you're comparing apples to oranges, and you really can't perform the capital allocation function at all. Number 2 is the great greenwashing fear. How do I know that these numbers are correct? No one is fully auditing these numbers now. There are agreed upon procedures activities going on out there. There are limited review activities or limited assurance activities that public accounting firms are performing, but the entire economy is trying to figure it out as we speak. And so the assurance function, having comfort in the numbers, the accuracy of numbers that you are looking at, is the second great question. The third great question is what Stephen Colbert, in his previous show, when he played that talk show host, he coined a word in his first or second year that made it into the dictionary, and the word was truthiness. And he said the difference between something that is truthful and truthy is that if it's truthful, we have objectively demonstrated its truth. If it's truthy, then we think it's true, it should be true, it feels like there's a truth there, but we have not yet objectively determined it to be true in all situations. And as a result, we should make no assumptions. Diversity. Yes, indeed. A more diverse organization is a more valuable organization. But is that equally true of all companies and all industries and all fields? And if there is some diversity in the extent to which that is true, might that affect my capital allocation strategy in the short term as well as the long term? And is it possible that sometimes you have to make an investment to earn a long-term return? And sometimes in the pursuit of diversity, you might risk losing some experience as you bring on younger and less experienced and more diverse individuals. Well, you could say, well, that's up to companies to develop, alternative modes of experience collection and knowledge management, so that as some people rotate off boards and others come on, you don't lose the cumulative knowledge of the older leaving the board individuals. But all these questions require measurements in a standardized manner that you can have assurance in that they are accurate and they are true. And so those are the three great questions. To conclude and to bring it back to the 4 bullet points that you see here. If you say, okay, Mike, so your point number 1, are we measuring things in a standardized way? Are there generally accepted metrics that can serve as a universal starting point to assess all the other measurements out there? Yeah, we CPAs, we accountants have developed them. The global entity that develops metrics and organized by different corporate functions is the Global Reporting Initiative. The American entity that says, well, defining metrics by corporate function does not take into account the fact that when you go industry by industry, there are industry specific metrics that should be measured. Well, that's the Sustainability Accounting Standards Board, the SASB, which is now the Value Reporting Foundation. If you say, okay, the GRI and the SASB measure these outcomes from the organization's point of view, but if the point of these initiatives is to have a positive impact on society, on metrics defined from society's point of view, yes, those are the leading standards are the United Nations SDGs, Sustainability Development Goals. So the biggest hurdle is just figuring out what we should all be measuring in a standardized way. That's where we're focused, and that's what the first 3 bullet points are designed to help you define. Second point, or second great question, shouldn't we have some universal approach to gaining assurance in the validity and accuracy of the data that we are using for capital allocation purposes? Yes. And the very latest and greatest guidance is the AICPA audit roadmap, which you see here. The title is a little bit misleading because this roadmap is not just for audits, but also for limited reviews and for much simpler agreed upon procedures. Honestly, what the roadmap says is data that is coming out should be subjected to the same review standards as any other management data that organizations have ever published. But there's more detail in that. What about the third question? What about concerns about translating data that I can have comfort in to actually understanding trends and changes in short-term and long-term value? Because ultimately, that's what I do. That I invest capital and I try to work with the allocation strategies to optimize my return while hopefully creating a better social outcome. So what about that value piece, that third question? You see that addressed at the end of the AICPA audit roadmap. But realistically, that's the cutting edge. And every firm is grappling with that question and coming up with their own proprietary systems. Eventually, we will start to have universal answers or approaches for answering that question, but we're not there yet. So you'll see that at the end of the AICPA audit roadmap, you'll see that being addressed. And then in the audit roadmap, you will be able to see references to more advanced materials to answer that question. Okay, that's my quick update. I guess I've given each of you, depending on your level of experience, a reading homework assignment based on these 4 bullet points. And Jamie, I'll pass the ball over to you and we can continue from here.
Thank you, Michael. And I've taken your tip of just staying very, very quiet. Not muting and unmuting. Thank you for that information. That's so critical. I think the reporting, it's interesting too with the sustainability. I just finished a Harvard online course around sustainable business strategy. And, the ESG reporting and some of those things, there's a lot of alignment there in what you're seeing from sustainability and what you're seeing in regards to diversity and equity and inclusion. For those of you who are listening, we do have the Q&A is open. So if you'd like to submit questions, we will take those up towards the end of the hour. But now I'd like to go back and ask a couple of questions of our speakers today. Now that we've heard everyone, it's really interesting to see how all of this is coming together. It's how much highlight everything is getting. This is a topic that, you probably were not attending a webinar on 5 years ago. You may be reading an occasional magazine article. Now it's a topic that everyone's looking for information on. So if there are things that you're interested in too, put those in the questions as well. But I'd like to go back. Ward, one of the things that Holly talked about when she was introducing you was your work in defining diversity champions. Can you tell us a little bit about what makes a good champion?
Yes, absolutely. So it's an award we give annually to CEOs and corporations who have moved the needle within their firms regarding diversity and inclusion. That includes increased hiring, increased retention of women and minorities, and just an overall support of the issue. So I was instrumental in CEO of PwC, who's created a great organization which brings together over 200 CEOs to support diversity and inclusion. We brought McKinsey to the table, who's been leading and creating research and documents to describe the need for diversity and inclusion. And it's not just a New York-based award, it's a national award. So CEOs that cover global companies, like a PwC, like a McKinsey, and others. So we had to cancel it, unfortunately, last year due to COVID, but we did have our virtual gala, which was phenomenal. So we will be looking to restore that event, and it is currently scheduled for the fall, November this year. And so what we do is we look at the data when companies can provide the data regarding their diversity and inclusion status, the policies that they have, but well as some uncomfortable information as like how many discrimination lawsuits they are currently dealing with, how many discrimination complaints. So this is the information and the data that Michael might not see because companies don't want to report it. But it's a great award. It's great to acknowledge companies that are moving the needle here. And it kind of forces them to continue to do the work and grow in the space. But I just want to follow up on some of the things Michael said, because I think it's key that the data collection is so important. And ultimately, I think it's an opportunity for innovation to happen in the standardization of this data. And I'm hopeful because if you look at the ESG space, let me just go over a few points that will show you the innovations that have happened so far. So the ideal of responsible investing occurred probably in the 60s, just the ideal of it. But it wasn't until 1970, during the first Earth Day, that it became a huge issue globally, where people began to care about the environment. And so after the first Earth Day, the Environmental Protection Agency was formed to deal with issues like water pollution, plastic in the oceans, and other serious issues of climate change. Then in 1980, further innovation occurred. The ESG movement accelerated greatly around the Comprehensive Anti-Apartheid Act, which outlawed any additional investments in South Africa. So that's an exclusionary component to ESG that was created. So then in 2005, Kofi Annan created the UNPRI, United Nations Principles of Responsible Investing. 2015, we had the Paris Agreement. And now in 2021, ESG related funds are the fastest growing funds on the planet. Europe is leading in many respects, but the US is close behind. This market continues to grow enormously and exponentially, and it will continue to grow. Michael also mentioned youth and being young. So one key statistic that kind of drives home for me the importance of the youth and ESG and the things that they care about is the fact that for the first time in history, people 16 years and younger in the US are majority minority. So that is the future of the country. That is the direction that we're going in. That's the demographics that we're going to have to find profitability with here in the US and abroad. So I'm very hopeful about the innovations that will occur and the increased growth of ESG. And so within that ESG is, of course, environmental, social, and governance. But the social and governance issue is huge because as we move forward, we can do is weight diversity and inclusion appropriately, or managers can do that as they like. I obviously like to weight higher diversity and inclusion when it comes to these issues. And so we look at companies and different indices that do that. So, but if you look at Bloomberg, Thomson Reuters, Morningstar, they all have ESG scores, but they're all different. And that's the case with the data collection as we currently see it. So there's a lot of room for innovation and opportunity going forward. Thank you.
That's so true. I mean, I think, just in the supply chain diversity side, there's third-party companies now that are doing reporting and collecting data, which I think is key. Because, I was always reporting into the financial side of the house. And so, these are people who they're not reporting their own numbers. There's third parties that are coming in and validating that. Right. And they're having to stand on, standards. So I think that if you're going to have the credibility that you need in the reporting on these issues, that you have to have the same sort of stringency around how that data is collected, how it's being reported, and as both of our speakers today pointed out, consistency across that. If you can't understand what's being reported, then I think first and foremost, it just makes you skeptical particularly if you're coming from the financial side of the house. I mean, I worked for a bank, and and also then in sourcing, we look at things, and the first thing we're looking for is where's the loophole. Where's the background story that you're not telling me here? So I think that you're going to see that across diversity. I think you're certainly going to see it across the ESG as well. One interesting question that's come in, and I'm going to throw this out, is what are your thoughts on how private company reporting will evolve? Currently, data is scarce for private companies. Do you see private equity playing a role here? And I know as a sourcing individual, I love doing my research on the public companies because it's all out there. When I start trying to do business with private companies, it gets very dicey very quickly because there's so much that's not available. Michael, let's start with you. What are your thoughts around this?
Sure. And actually, the theme of this answer is there really is nothing new under the sun. So if you say, well, when are private companies going to need to disclose this? Well, if you look at financial reporting standards under US GAAP, defined by the FASB, they've essentially, not 100% across the board, but for most of their new standards, they say, when we issue a new standard, when we have a new requirement for large publicly traded companies, the large publicly traded companies must adopt that first, and small publicly traded companies, private companies, and nonprofits follow as a requirement the need to report 2 years later. Now, of course, with COVID and with other issues, we've seen certainly deviations from that. But as a general policy, large public firms come first, everyone follows. Now, you might then say, okay, but what if the government regulators just don't, require that? Well, then you have organizations doing what famously BlackRock has done, which is to say, with some exceptions, of course, if you don't have this data, you don't get our capital, or at least you don't get allocations from certain significant pools of capital. Now, you might think, well, so what? There's a world of capital washing all around the globe. Well, yeah, but just look at history. There have been many, many movements. The one I remember most vividly is the don't invest in South Africa movement, or don't invest in weapons manufacturers or cigarette companies. At first, they're a drop in the bucket. But before you know it, there's an activist or two that gets appointed to your board, as ExxonMobil found out a couple of months ago. And suddenly these privately driven, whether they come from the PE, private equity, or the hedge fund area, or other areas of the financial world, these privately driven priorities do make themselves known. Now, finally, there's a third point, I would make, which is there's data and there's data. Does everyone believe every last bit, every last statistic that is reported by China? And just to be fair, does everyone believe in the perfect accuracy of every last metric reported by the US government? Well, not fully 100%, no, not quite. And so what do? You look for alternative data sources. You look for private data elements. There are other ways to get at information. Most vividly, and I won't go down this rabbit hole more than for 15 seconds, I promise. You might have noticed within the last day or two, Netflix said, we're going into the gaming business. Video games will complement our movies. And if you look at today's news scroll on CNBC.com, there's a very interesting article that says, why does Netflix really want to go into gaming? Well, number one, there are some synergies with movies. Number two, if you gather as much information about how people make decisions during game playing as information about what movies they like, the information you can glean about what people want to buy from their playing of games and from their watching of movies gives you a heck of a lot of synergistic data. And so my bottom line is, whether you're gathering sort of unofficial performance data about the Chinese economy because you don't have perfect comfort in the official data, or you're Netflix and you're saying, let's see what people do when we watch them play games. We can learn more about them. If you take that concept and apply it back to what we're talking about here, if you don't quite have the data you really want from private firms, there's an awful lot of other data that you can collect that helps you get to a lot of the answers that you're looking for.
That's true. I mean, and I think the reverse is true as well. In that, you know, I had the opportunity to interview a partner at EY a year or so ago, and I was asking about diversity and how it impacts in their recruiting. And he said, well, you know, we're recruiting mostly newly MBA grads, you know, that sort of demographic. And I said, okay, so are you finding that they expect you to have something in relation to diversity and sustainability? And he kind of laughed and he said, expect? He said, no, he said, they demand. And he said, and quite honestly, if we can't demonstrate viable results in those areas, they either won't join at all, or they'll join and then they'll move on very quickly. And so the whole impact of social media has created a sense of, I know what my companies are doing and where I'm spending my money. I can have a lot of impact now. I think that's why you're seeing a lot of these companies come forward and CEOs that are making stands that 10 years ago they wouldn't have touched, you know, with a 10-foot pole. We're just not going to get involved. Because now if you're not doing it, what's wrong with you? And that's the first question that people are asking. And because that information is so permeable and out there, they can get that. So another question that came in was, you know, generally speaking, are companies' ESG and diversity level scores currently factored into stock prices, or do capital markets not fully reflect these yet? Which I think is a really great question, because again, with the class I just completed, we were actually looking at that, at, you know, the leading companies who are including it, and it is included in compensation and you know, bonuses and bottom lines and so on and so forth. Ward, can you comment on that a little bit for us?
Sure. But first, let me just touch on the last question,
Okay.
just quickly. The reality in today's market is that private companies are staying private longer. So they go into IPO much later. And so when you look at what NASDAQ has done, and they're requiring companies that they list, new companies that they list, that report their D&I, and to have minority members on the board, which I think is a great way to go for companies, to push them forward towards diversity, equity, and inclusion. And you see a few large banks and corporations now, for any company that they're going to take public, they also require this D&I data, as well as board members and senior executives to be diverse as well, or at least included in the company's perspective. So I think that's a good way to go. It's a lot of progress happening there. But the companies that have no intention of ever going public, yes, there's no requirement for them to release the data, but the smart ones will definitely release the data. So when it comes to the ESG scoring with corporations, our largest corporations, the Dow, the S&P 500, those companies that are listing their data are seeing increased buying. They're included now in, like I mentioned earlier, the indices that are now ESG focused, from the Bloomberg data to Sustainalytics, which is a great firm that has indices that list all of the ESG data with these companies. So it gives them additional exposure to the current demand for investor appetite into the ESG funds. So it's great for the companies going forward. And is it priced in completely? It's not yet, but it is priced in somewhat with some of the larger firms. But as the reporting will evolve, we'll see differences in strengths and weaknesses with companies that outperform because of their increased diversity and inclusion. And those companies will benefit greatly from the increased inflows.
So along those lines, another question that came in, so privately owned companies in SME space did not face the same external pressure as publicly listed companies to implement ESG into strategy. How are we going to approach this problem? So aside from the consumers voting with their wallets and large companies requiring the same commitment that they have, Michael, what are your thoughts around that?
So I'm going to dive just a little bit deeper into the Global Reporting Initiative, the GRI data, which is the first of my 4 bullet points. I had mentioned previously the organizational structure of those standards is there are about 36 different corporate functions that every company should pay attention to, ranging from diversity to the environment to other corporate social responsibility fields or concerns. Not every function is equally important to every company. As a result, what each company chooses to focus on and chooses to report, and conversely, what each company chooses to ignore or not report. The omissions are just as important as the disclosures. You just look at the data and you say, hey, according to the GRI, you're supposed to report this in this way, and you did. And you actually reported in accordance with GRI standards, but you completely ignored this other area, this other set of standards. That is meaningful. Now, ultimately, can you force a private company to change? Well, again, there's nothing new under the sun. My prior theme. There are many, many ways, many levers to power, if you will, that you can use to enforce change or compel change, ranging from boycotts to voting with your feet to public humiliation of companies that are doing things that you don't want them to do, depending on how strongly you feel about it. The GRI, those metrics, give you tools to identify what you should be focusing on when it comes to private company reporting, what tools the company itself is using versus the tools that the company is willingly choosing to ignore, actually tells you an awful lot about what the company is most concerned about and where their pressure points might be. And what you do to compel change is what we have always done to compel change in behavior in any company, whether it's compelling the coal companies of a century ago, not to beat up on their union organizers, which was a big deal at the time in the coal industry, or what we're talking about today. I know that's not the magic approach. The magic approach to say, if only we did this with all private companies, they would all change. That's not realistic, but I think we have the information that we need from organizations like the GRI to figure out how to strategically compel change. And we have all the same challenges, but all the same opportunities to compel the change that we've always had in decades and even centuries past.
Getting close to the top of the hour, I'm going to ask each of you to give me 2 items to wrap up. One is a great question that came in, which is, what is the biggest stumbling block to adopting or increasing a commitment to diversity. So biggest stumbling block. And then the second thing is, if I'm sitting here listening to this today, what's one thing that I can go into the office tomorrow and do that's going to either educate me or help me move this forward? Michael, let's go with you.
Sure. I was a lifelong Northeasterner, born and raised in Brooklyn, and then lived many years in Southwestern Connecticut. And now I'm in the last about 3 years, Houston, because I felt I could make proactive change best by working with an academic institution down here and continuing my other work as well. Finding your opportunities large and small based on whatever is available to you, and then making it happen is the way forward. Pete Rose, the greatest baseball hitter, who also is not in the Hall of Fame, used to have an expression. People would ask him, "How come you have so many hits? What's your secret?" And he said, "I see the ball, I hit the ball." I mean, it's as simple as that. And people have parodied that answer since then. But I would translate that into our language here, whether it's an organizational level approach or a personal level approach. Set a goal that is meaningful and achievable for you, and then go out and achieve it. And if you don't, learn from your error. If you're in the business of actually making decisions about the allocation of capital, take, at least initially, a little bit of capital and put your money where your mouth is, so to speak, and make the best investment policy decision that you can, at least with a small amount, understanding that what is small to one might be bigger to another. I get that. But jump in, use the information, the data, the metrics, the tools that are available, and start from there. What can you do at an individual level? Ward, I guess this will be my handoff to you, but if you want diversity, try to put yourself in a position where you are mentoring people and helping people who come from diverse backgrounds. It's as simple as that. Not everyone has the personal flexibility to travel to Houston, Texas from Southwestern Connecticut to do that. I understand that. But, on a retail basis, person by person, set the goal for yourself, make the goal, pat yourself on the back, and set a bigger goal. Move on from there.
Very good, Michael. Very good, Michael. So I think for me, what would seem to be, from a business standpoint, what would be the most compelling reason to increase your diversity and inclusion would be profitability of companies, of increasing the GDP of the nation. The numbers are there, the stats are there. And so if an activist investor were to look at the United States as a whole and say, how do we unlock value here? How do we grow the GDP of this nation efficiently? And at the top of that list would be increasing diversity, equity, and inclusion, and giving opportunity to a larger percentage of the population. They say that if we used all of the brain power, we might have found a cure to cancer by now. But so many people are left out of finding solutions to unique problems that we're limiting our growth. And so profitability, when that's not compelling, what we're seeing also is going forward, the House and legislation can be good. So the House recently passed legislation that requires companies to disclose their ESG metrics. So that will lead to standardization, hopefully, and the SEC is considering disclosure rules as well. So that will make it mandatory, and we'll see some progress there. And on an individual basis, for the people that are on this call and watching this, I think the most important thing we can do as individuals is to be a part of this, to align with the interests of this, is to increase the awareness, talk about it, Share this information with as many people as you can. I'm sure many of you know people who are on the other side of the fence or disagree with this and this conversation. So please share it with them, make them aware. We are in this space of increased awareness, and it's important that we continue that. In the middle of this increased awareness, we're seeing some backlash. I guess Michael probably could speak to this and what's happening within the education space, the denial, refusal, and limiting of conversation and of debate. Things that you might seem to be a First Amendment right are being taken out of classrooms throughout Texas and Oklahoma right now. There's a lot of work to be done, but the awareness is key. And so I just would like to commend all of you for sharing this story with someone tomorrow in advance.
That's great. That's great advice too. Thank you both. Warren Buffett said once he was optimistic about what we were going to be able to do with women in business, because look what we had been able to accomplish with 50% of our brain trust. So I think it's the same thing. I really appreciate both of you today. These insights and this discussion has been excellent. As we said before, the reference materials and stuff will be available after this. And now, as we come up to the top of the hour, I'm going to go to BJ Bellick, who's going to wrap things up and tell us about what's coming up. Thank you.
I appreciate that. I'm BJ Bellock. I am on the management committee at the Roundtable. And on behalf of the Roundtable, I'd like to thank Ward, Michael, and Jamie for a great presentation, a lot of things to think about and to, as Ward said, share with others when we leave here today.